My name is Farhan. This video will show you how to solve question number 2 from 2019 past exam. This question requires you to reconstruct the ledger accounts for accounts receivable, accounts payable, and inventory. You will also learn to prepare the operating activities section for the cash flow statement. This question has many complications, so make sure to follow through the entire content because I anticipate a similar question coming up in the upcoming 2024 exam. If you need tutoring sessions, make sure to check the link in the description to book a call. With that being said, let's get started. Freja's Furniture reports every 3 months. The business is preparing its cash flow statement for the 3 months ended 31 December 2019. The business provides the following information. So you can see that we're given the balance sheet extracts as of 30 September 2019 and 31 December 2019. We are also given information for sales, cost of sales, 2 different types of expenses, drawings and inventory loss, and other additional information that we need to include in our workings. The main requirement for question number A is to reconstruct the ledger accounts for accounts receivable and accounts payable and inventory, and mainly identify any cash inflows and outflows that we will include in the cash flow statement. So on the right hand side, you can get to see all the workings that I've done. First of all, let's understand something. The closing balance at 30 September 2019 will become the opening balance at 1st of October 2019. All right. So having said that, we start reconstructing the accounts receivable ledger account first. We understand that accounts receivable is an asset account. Why is this an asset account? Accounts receivable refers to the credit customers of the business. These are the people to whom the business has sold goods on credit. So therefore, these customers owe the business some money, so there is some economic benefit attached to these people. Assets, by default, are always debited, which means when they increase, they are debited. Also, within the ledger account, assets should always have an opening balance on the debit side and a closing balance on the credit side. So you can see the ledger account outline was already given to us in advance, and we understand that this is the debit side and this is the credit side. So you can see that on the 1st of October, we have included the opening balance on the debit side of 28,000. And on 31st of December, we have included the closing balance on the credit side of 18,000. So where did we get each of these numbers from? So let's scroll back up and you will see that the accounts receivable closing balance at 30 September 2019 was 28,000, which becomes the opening balance on 1st of October 2019. And the closing balance for the most recent 3 months ending 31 December 2019 was 18,000, which is what we have included as the closing balance here on the credit side. So make sure to write the dates properly. So as you can see, 1/10 referring to 1st of October and 31/12 referring to 31st of December. Now, when do accounts receivable go up? When we make more credit sales to these people, right? So if you check the question in this section, they have provided us with the sales, which is 80% cash, and the total sales is $400,000. So if the total sales is $400,000 and 80% of it is cash sales, the amount for cash sales that we can calculate is 80% multiplied by 400,000, which gives us $320,000. Now, if 80% is cash, then 20% of the sales must be credit, which means the credit sales in dollar amounts would be 20% multiplied by $400,000, which gives us $80,000 as the amount for credit sales. So this $80,000 is what we have sold on credit to our accounts receivable. But your accounts receivable do not just owe you the amount for sales of the inventory only, but also the 10% GST that goes on top. So if we want to find the sales including the GST, that should be $80,000 in the actual dollar amount for sales, plus an additional 10% that we apply on the 80,000, which gives us $88,000 worth of sales, including GST clearing. And this is the amount that our accounts receivable should owe us. So back to the reconstruction for ledger accounts. So you can see that for the 3 months ending 31st of December, we have included sales, including GST, of $88,000. So make sure in exam to write sales slash GST query. I just don't have enough space. So I just wrote sales slash GST in this case. And you need to include the GST amount with the original dollar amount of sales as well. Now, why are we including this on the debit side? Now, what's the logic of including this on the debit side? Now, assets, as we have already discussed before, by default are always debited, which means when they increase, they are debited. So that is why when we are making credit sales to accounts receivable, those customers now owe us, the business, more money. So that is why, because they are our assets and because now they owe us more money, that means we have to debit them within the ledger account. So that is what we have done. So on the debit side, we have included sales, including GST clearing of $88,000. Right? So there is really nothing else relevant to accounts receivable in this question that we need to include. However, we need to find the totals on the heaviest side and also calculate the totals on the credit side. So what we are doing here, you can see the bank is highlighted in yellow. So that is the missing figure that we have to derive. So what we do is first find the total of everything on the debit side, which is 28,000 opening balance plus the additional sales that we have made in this period. That gives us $116,000 in total, which must be the total on the credit side. So to ensure that the fundamental rules of accounting apply, and when we subtract the closing balance at 31st of December of $80,000, we're left with $98,000, which is what refers to the cash that we have collected from our accounts receivable for the period ending 31st of December 2019. So that is why I've highlighted this in yellow, because this was the missing figure that we had to derive ourselves. So we are writing bank here as 98,000 because you see we have included this on the credit side, which means this line here refers to a reduction in accounts receivable. When assets go down, we have to credit it. So that is why we have included this on the credit side. So bank at 31st of December of 98,000 on the credit side within the accounts receivable ledger account simply refers to cash that we have collected or cash that we have received from our credit customers for past sales that we have made. So once you have finalized everything, do not forget to also carry forward the closing balance at 31st of December as the opening balance on 1st of January of $80,000. Because you will lose marks if you do not do that. So make sure to always include it for any asset, liability, or equity account. So now that the accounts receivable is taken care of, let's see what we have to do with the second account, which is accounts payable, and also the third account, which is inventory. So we understand that accounts payable is a liability account. Why? This is because accounts payable refers to the credit suppliers of the business. Who are the credit suppliers of the business? So these are the people from whom the business purchased inventory on credit. Now, that is why we have an obligation to pay these people off. So we have a present obligation to pay these people off because of the inventory that we have purchased from them and the promise that we have made to repay them at some point in the future, at some point in time in the future. So liabilities should always have an opening balance on the credit side and a closing balance on the debit side. Also, liabilities by default are always credited, which means when they increase, we have to credit them. Basically, this is the exact opposite for treatment compared to the assets. So let's go back to our question. And you can see that accounts payable had a closing balance of 60,000 on 30 September 2019, which will become the opening balance on 1st of October 2019, and a closing balance of 65,000 on 31st of December 2019. So here you can see within the credit side, I've included the opening balance on 1st of October of 60,000, and also on the debit side, I've included the closing balance at 31st of December of 65,000. Now, accounts payable goes up in value when we purchase more inventory from our suppliers on credit. Based on the question that we are given, we understand that all purchases of inventory were on credit, and we had some terms. We 5/10 N/30. What does that mean? So that means 5/10 here simply means that we get a 5% discount if we pay our suppliers within 10 days. Otherwise, we have 30 days to repay them, and after the 10th day, we do not qualify for getting any discount. But the question explicitly mentions in the next sentence that the discount is always taken. Now that we know all this information, we also need to understand something else. Accounts payable and inventory, they are relevant to each other in the sense that the more inventory we buy on credit, the more is our accounts payable going to be. So that is why, before anything else, we also want to do the opening and the closing balances for the inventory account as well, because they are interconnected and relevant to each other. So we need to first finalize the inventory account, get the relevant amount for purchases on credit, and then transfer it to the accounts payable, and then we could do all the balancing later. So first of all, we understand that inventory is an asset account as well. So which means the opening balance must be on the debit side and the closing balance must be on the credit side. So on the 1st of October, you can see I've included the opening balance of 22,000 on the debit side. And you can also see that on 31st of December, we have included the closing balance on the credit side of 25,000. Let's scroll back up to verify these numbers. So you can see inventory had a closing balance of 22,000 on 30 September 2019, which becomes the opening balance on 1st of October, and a closing balance of 25,000 on 31st of December 2019, which is what we have included here. Now, this amount that you see here is the one that we had to derive ourselves. So I'm going to highlight this in yellow, and we're going to come back to this eventually. Now, you can see that on the credit side of the inventory ledger account, for the period ending 31st of December 2019, I've included cost of goods sold of $210,000. So why is cost of goods sold going on the credit side? The cost of sales simply refers to the amount that we have paid to buy those inventory which we have sold to our customers. So obviously, whatever inventory we as a business had sold to our customers had to be purchased before from our suppliers, right? So that's the cost of sales, which is what we are referring to. So why is cost of sales on the credit side? This is because when we are selling the inventory, we are getting rid of that batch of inventory, right? So if we are selling that inventory, that reflects a reduction in the assets that we already have in our business. So that is why, since the assets are going down because of the inventory that we are selling, we need to show that on the credit side of the ledger account for inventory. So cost of goods sold for the period ending 31st of December 2019 is $210,000, which is what we had got from the income statement extract. As you can see, it's given here, cost of sales of $210,000, which reduces the inventory. And because it reduces the inventory, it's essentially reducing an asset. And when assets go down, we have to credit it. And when assets go up, we have to debit it. So on the credit side, we're including cost of sales of $210,000. Next, let's scroll back up to the question. So you can see that we have also been provided with some inventory loss of 4,000, which again results in a reduction in the balance for inventory. So again, if inventory is going down, it refers to assets going down, and if assets go down, we have to credit it. So that is why you can see that for the inventory account on the credit side, we have included inventory loss of 4,000, which refers to the inventory or the asset going down. Now, let's go back to the question again. So you can see under additional information, in the second line, we got purchase returns of $6,000 plus GST. So purchase returns of $6,000 plus GST has to do with what? So if we're returning purchases, then that results in a reduction for the amount of inventory that we hold in the business as well, because purchase returns refer to returns that we as the business have given to our supplier. So I'm going to correct this because this should be decreases inventory. I apologize for that. So let's scroll back down to the reconstruction for the inventory ledger account, and you can see that I've included in purchase returns of 6,000 on the credit side, which again refers to a reduction in the balance of inventory that we hold. And why are we writing accounts payable though? Because we understand that all the inventory is purchased on credit, which increases our liability and which increases the amount of inventory that we will hold in the books. However, now that we are doing this return, that decreases the liability or our obligation to our suppliers or our accounts payable. And also, when we are returning this inventory, that reflects a reduction in the amount of inventory or assets that we have in the books. And when assets go down, we got to credit them. So that is why we refer to accounts payable of 6,000 on the credit side of the inventory account, which refers to more inventory going out of the business. Now you can see that I have not included the amount for GST in these calculations, and this is because the inventory account that we have only calculates the real amount that is relevant to inventory. The GST that we are paying on inventory is only what we will be paying our accounts payable and should only be included in the ledger account for accounts payable because that's their obligation, our supplier's obligation to take care of that with the ATO and pay that GST that they owe. So that's not our concern when we record this within our inventory account. So that is why we have to record the purchase returns without the GST, and that is 6,000 only. So the yellow highlighted thing here on the debit side is the missing figure that we had to calculate, which refers to the additional purchases of inventory for the financial period ending 31st of December 2019. So how do we find that? So if you were to not have this in place, how would you find the missing amount? You would find the total for everything on the heavier side, which is the credit side. And when you add everything on the credit side, you get 245 as the balance, which must be the balance on the debit side, ensuring that the fundamentals of accounting apply. And once you subtract the opening balance of 22,000, you're left with $223,000, which refers to the additional purchases of extra inventory from our suppliers on credit for the period ending 31st of December. Again, we're not worried about GST in this case because this is not our headache, not our obligation. We will be paying this GST to our supplier, and that will only be reflecting within our accounts payable ledger account. So once you find 223,000 here, so you have the totals matching on both sides. Again, do not forget to transfer the balance. So the closing balance of 25,000 needs to be transferred as the opening balance on 1st of January as $25,000, which is what you can see we have included here. Okay, now let's go back to the accounts payable reconstruction. So remember, we stopped after we discussed the opening and the closing balances, but But let's see what else is there to be done. Now, we understand that during the period ending 31st of December 2019, we purchased $223,000 of extra inventory from our credit suppliers or accounts payable. And we also understand that within the inventory account, we're not going to include the GST, but within the accounts payable account, we have to include it, which reflects the total amount in cash, not just in cash, like the total amount that we owe our suppliers, including GST. Now, inventory, including GST, will therefore be calculated at 223,000 being the original dollar amount plus an additional 10% applied on 223,000, which makes it $245,300. So on the credit side of the accounts payable ledger account, for the period ending 31st of December 2019, we are showing inventory including GST of 245,300. Okay, and I've put a star here just to show you the workings that you can see on the right hand side. So we have got this two sorted. We also understand the closing balance, where it comes from. What about this one, 6,600? So this 6,600, as you can see, the cross-reference is inventory plus GST. That refers to the purchase returns of 6,000, if you recall. So the purchase returns of 6,000 plus GST. So that is why this is including GST, 6,000 plus an additional 10% applied on 6,000, which makes it $6,600 in total. Why are we including this on the debit side though? This is because we have returned some of the inventory that we have purchased previously, which reduces our obligation towards our suppliers. And because our obligation goes down, that refers to liabilities going down. And when liabilities go down, we have to debit them. So that is what we are doing here within the ledger account for accounts payable. We are showing this on the debit side at 6,600, including GST. Now, let me highlight these two lines here, because this is the missing amount that we have to derive ourselves. So how do we derive this? Again, let's just assume we do not have these two numbers to begin with. And if you take a quick glance, you can understand that the heaviest side is the credit side. So therefore, we add everything on the credit side first, which is the opening balance plus the inventory and GST, that inventory purchases including GST, and that is 305,300, which must be the total on the debit side to ensure the fundamentals of accounting apply. And once we subtract these two balances, let me take you to the right hand side for the workings. So you can see 305,300 is the total for what we got on the credit side. Yeah. Then we subtract what we have been given, excluding these two, on the debit side, which is 65,000 and the 6,600, which means 233,700 must be the deficit that needs to go on the debit side to ensure the whole ledger account is balanced. However, we also understand that this 233,700 refers to two different things. First of all, the payment that we are making to our accounts payable, and second, the discount that we're receiving in return. The question explicitly mentions that the discount was always taken, and the discount is 5%. So how do we find the amount for the discount? So whatever deficit we are left with on the debit side, 233,700, which essentially refers to the reduction in accounts payable as a whole. 5% of it refers to discount, which means 5% multiplied by 233,700 gives us 11,685 as the revenue for discount that we have received. Then the other 95% will refer to the cash payment that we have actually made to our credit suppliers, and that is 95% multiplied onto 233,700, which gives us 222,015. So that is why you can see on the debit side, we have broken this deficit into two lines, which you must do in the exam if you want to get full marks. So first of all, bank payment of 222,015, which reduces our obligation to our accounts payable. And because our obligation goes down, liability goes down. And when liability goes down, we have to debit them. And that is what we're doing here. We're including this on the debit side. Then we're also including the discount revenue of 11,685, which again reduces our obligation. And when our obligation goes down, our liability goes down, and liability goes down, we have to debit it. So that's what we have done. And then you should see things automatically add up and gives you the final balance for the both debit and credit sides. Then again, do not forget to transfer the closing balance as the opening balance on 1st of Jan 2020, and that is 65,000, as you can see we have done here. So the first question is taken care of now entirely. Now let's look into the second question. The second question asks you to calculate the amount of GST paid on cash payments. Okay? So cash payments here could simply refer to the expenses that we have paid for in cash. Now, let's do a quick scan of the balance sheet, and you can see that the expenses that we got there should be the advertising and the wages, but wages cannot have GST, right? Because wages are the payments that you give to your employees, and those payments are already taxed on a personal level. So that has no relevance to GST. So the only thing relevant from the balance sheet extracts is prepaid advertising. So you can see we did not really have any prepaid advertising to begin with on 1st of October 2019, but we have some prepaid advertising that we have paid for, and that is $4,500 at 31 December 2019. So prepaid advertising of $4,500 at 31 December 2019 refers to a current asset which hasn't been consumed yet, but will be consumed in the next period. And this is the advertising that we are paid in advance, which means some cash has gone out of the business. So this is a cash payment. So this prepaid advertising must include a 10% GST. So that will be 10% multiplied by 4,500, which gives me 450. Then you can check the other information that we're given here. And you can see we already understand wages are not relevant. Neither are these two lines, or not the sales or the cost of sales, but the advertising expense should be, which is $15,000. So the advertising expense of $15,000, we multiply 10% GST on top, and we get $1,500, which gives us the total GST for cash payments to be $1,950. However, a lot of students I've tutored, they seem to be confused with something, which is the GST settlement. So you can see the last line of the additional information, which also talks about a payment of $31,350 made to the ATO in December as a GST settlement. Now, this GST settlement refers to the obligation that we had towards the ATO that we had to take care of. This is not really relevant to any expenses that we have paid for in cash, which triggers the GST that we need to pay on top. So this is a settlement. So the settlement here is different to the expenses that we have paid for in cash. So you need to be careful of this difference. Another thing you want to understand is that the GST settlement is the net balance for GST that we could calculate. And that could be relevant on the GST that we have collected from our customers, or the GST that we have paid to our suppliers. So on a net basis, that's where the settlement comes from. The settlement here is not relevant to the GST paid for cash payments, which mainly refers to the expenses for the period. Okay, so that is why the final answer for part B is going to be 1950, 1,500 coming from advertising expense, and 450 coming from prepaid advertising. Now let's move to question number C. All right, so question C requires us to prepare the operating section of the cash flow statement for the 3 months ended 31 December 2019. So let's scroll back down, and you can see we are given the cash flow statement extract, and I've prepared it. So starting with the cash sales of 320,000, where did we get this amount from? So let me remind you of the workings that we had done initially. We know that the total sales was 400,000, 80% of which is cash, which gives us 320,000. And Do not forget to include the GST that we will be receiving, because in Australia, you do not just make sales, you also have to charge the 10% GST from your customers. And the GST we are going to receive is 10% of 320,000, which is $32,000. Now, then we're including the cash that we have collected from our accounts receivable, and that is 98,000. So what we have done here is the first three lines refers to all the cash inflows, all the cash coming into the business. Then we have shown all the cash outflows, starting with how much we have paid our accounts payable. We have paid our accounts payable 222,015. So let me scroll back up to show you where we got that number from. So you can see accounts receivable 98,000 that we received, and accounts payable 222,015 that we have paid. Discount revenue is not something that is relevant to cash. It's a non-cash income. But any payment that we have made to accounts payable through our bank, we refer to a cash outflow, and that is 222,015, which is what we have included here. Excuse me. And then we have advertising. I have included 90,500 within brackets, which refers to an outflow. So how do we get 90,500? So if you remember, we paid 4,500 for prepaid advertising, and then we also had an expense of 15,000 for this period. So both of these added together makes it 90,500, and that's an outflow, so which is why we kept this in brackets. Then for the wages, I have kept this blank because I want to show you some workings. So let me scroll back up to the question first. So you can see that we got some accrued wages. So on 30 September 2019, we had accrued wages of 1,000, and on 31 December 2019, we had accrued wages of 800. So on the right-hand side, you can get to see a ledger account that we have to do as a part of our workings. So accrued wages is a liability account. We do understand that. Why? Because accrued here refers to the obligation that the business has because the staff has already worked, but the business didn't pay them yet. So accrued wages, being a liability account, should always have an opening balance on the credit side and a closing balance on the debit side. So this is the credit side and this is the debit side, we can understand. So I've written the opening balance. I'm just writing OB in short, so do not worry too much about it. So OB on the credit side, the opening balance is 1,000, which is what is coming from the closing balance on 30 September 2019. That becomes the opening balance on 1st of October 2019. And the closing balance at 31st of December on the debit side of 800. So once we have got the opening and closing balances sorted, next we understand that the wages expense for the period is 55,000. So wages expense for the period is 55,000. So wages expense, if I was to prepare a journal entry for wages expense, how would I journalize that? So I would debit wages expense by 55,000. Why am I debiting wages expense? Because expenses are always debited by default, and we are going to credit accrued wages by 55,000. So that is what is being reflected within the ledger account here. So since the accrued wages is credited, so on the credit side of the ledger account, we have to show that accrued wages is credited because of the expense of 55,000 that has been incurred during the financial period ending 31st of December 2019. Okay, so the highlighted line is what we had to derive ourselves. So again, we follow the basics to what we have done before. If you quickly take a glance, you will know that the heaviest side is the credit side. So we find the total of everything on the credit side, which is 55 plus 1, which gives us 56,000, which must be the total on the debit side as well. And once you subtract the closing balance, what we are left with is $55,200. And I'm writing bank here because this refers to the payment that we have actually made in cash for the wages to our staff. So going back to the cash flow statement, cash flow statement should basically only have cash inflows and outflows, nothing else, just to simplify it. So that should be 55,200 within brackets, which refers to an outflow because this is wages that we have paid from a bank account to our employees. Then we got GST paid of 1950. So do not forget that. We should have written this right after advertising. Otherwise, I would have forgotten this too. The 1950 is basically derived based on the Part B calculations that we had. Advertising expense 10% of 15,000, 1,500, and then prepaid advertising 10% of 4,500, which is 450. So together they give us 1950. And then we have the GST settlement of 31,350, which is based on the very last line in the additional information. As you can see here, a payment of 31,350 was made to the ATO as a GST settlement. So that is what we have included here, 31,350. So once we have done that, you can see all the cash outflows and all the cash inflows. So we just basically add, subtract whatever is needed, and whatever we get in this case is a surplus, and that is 119,985. And because this is a surplus, we need to write net cash flow from operating activities. So you could write operating activities. I just quickly wrote operations. It's the same thing. Okay. All right. So now the last part of the question, so which is question number D. Explain giving two examples how the net cash flow from operations can be higher than the net profit for the same period. Okay, so when can net cash flow be higher than net profit? All right, so net profit is calculated under the accrual basis assumption, which simply means revenues earned less the expenses incurred. Okay, so the revenue has to be earned and the expenses actually have to be consumed within this period. That is why we say expenses incurred. Now, when it comes to the cash flow statement, we only include cash inflows and outflows. Now, cash inflows and outflows can have many things in place. Now, the question says net cash flow from operations, but let me talk about the whole cash flow statement as a whole. So if you think about the cash flow statement, we have cash inflows and outflows, and inflows could refer to money that you're getting from sales. Outflows could refer to purchase of non-current assets. And when you're purchasing non-current assets for cash, you're using the money on the bank funds. You could also think of investing activities, financing activities, which are not in this question. But if you had a question where you were given investing and financing activities could refer to selling a non-current asset for cash, which increases the cash and is a cash inflow, or purchasing non-current assets for cash, which decreases the cash balance, and that could refer to a cash outflow. And if we were to talk about operating activities in our question, for this question, we understand that the cash that we receive from accounts receivable and the cash that we have paid to our suppliers are the two operating activities that we can look into. Moreover, we also understand that receipts from accounts receivable could be higher than the current period credit sales, because whatever we're receiving from accounts receivable could also come from previous period sales. So let me show you something quickly. So within the ledger account for accounts receivable, you understand that the sales was actually 88,000 including GST in terms of credit, but you actually received 98,000, and this is because this 98,000 also includes amount from previous periods as well. If you look into the accounts payable, the inventory that we have purchased, including GST, is 245,300. But in terms of actual amount that we have paid, it's 222,015. So you can see differences already coming here. So that is why net cash flow from operating activities can be higher than the profit that we're reporting, because the profit, as we have already discussed, is calculated under the accrual basis assumption as revenues earned minus expenses incurred, and those should only relate to the current period. Also, a business can have a lot of accrued expenses, which means less cash can be paid out than reported expenses for calculation of profit. If we take a look into the wages expense, it's 55,000. But in terms of accrued wages, you can see that the closing balance was 800, and we calculated that we had paid 55,200 for wages when the expense is actually 55,000. Again, this 55,200 could also include numbers that refer to previous periods as well. And again, you could see a discrepancy between cash outflow, which is what happens when we pay wages, and the net profit that we would be reporting based on the wages expense that we had included here. Now, income statement consists of expenses such as inventory loss as well, because inventory loss is an expense, which is a bad thing for the business, and therefore it's going to reduce the profit, right? But inventory loss is not exactly cash, right? Because inventory loss could be something relevant to some stock that was left behind and it became obsolete over time. And because it became obsolete over time, the value that's remaining within that inventory is now potentially less, which refers to the loss, which would be going into the profit and loss. But this being a non-cash item would not really be reflected in the cash flow from operating activities, right? We could also talk about depreciation expense, which is not something that we really have in this case, but depreciation expense is also a non-cash expense, which refers to the loss in the value of a non-current asset that will be included as your expense in your expenses to calculate net profit, but won't necessarily be included in the operating activities section because it is non-cash. So that is why all these things that we have just discussed, they could all add up or whatever, and then you will see that the net profit could be lower or the cash flow for the period could be higher. So that is why you need to check the question carefully and all the examples that we have discussed. You gotta talk about similar stuff in the exam if you want to get full marks. Again, that's all for today's lesson. So if you want to discuss your tutoring requirements, make sure to check the link in the description to book a call. I'll see you in the next lesson.